Hi, I'm Doug Carroll for InsidersGuideToFinance.com, here today with a brief presentation for you on repos, or repurchase agreements as they're sometimes more formally known. Repos are a really important financial instrument that make great contributions to the efficient functioning of the fixed income markets. In particular in the U.S., they're widely used financing vehicles, especially in the U.S. Treasury and agency mortgage-backed pass-through securities market. Now, note what I said as part of that description. I described them as a financing tool. So despite the fact that repos are oftentimes presented as money market instruments, and they are, I don't mean to say they're not, in reality, repos are financing techniques that are masquerading as a couple of paired trades. But before we dig way into the substance, let's first get a handle on the structure of the transaction so my subsequent explanation of the substance of what's really transpiring makes more sense. So, what's a repurchase agreement? Well, the repo is a set of paired transactions between two counterparties. Now, while the counterparties can be drawn from a wide variety of market participants, and the securities subject to the transaction are whatever the two counterparties agree, let's look at one of the more common cases, where it's a mortgage-backed securities or treasury securities dealer that's using it as an inventory financing vehicle. So in such a transaction, let's say on one side we have a broker-dealer holding securities needing to raise cash, and on the other side we have some financial institution, we'll say an insurance company, but it could be any number of financial institutions that has some money to invest that they'd like to invest in a very safe fashion for a very short period of time. So what's going on between these two counterparties? Well, assuming they find one another in the repo market, the broker-dealer will hand over securities and receive money from the insurance company, but at the same time they're writing up the order ticket for that exchange of money for securities, they're going to write up a second order ticket showing when the broker-dealer turns back the money with interest, they get back the securities. Now, note that at the top of the exhibit, the formal name of these transactions is actually shown. Because despite the fact they're usually called repos or repurchase agreements, sometimes even RPs for short, the formal name of the transaction is really sales under repurchase agreement. Because you'll note at the time of the original exchange of money for securities, and the order ticket for that transaction was written up, that sale was agreed to only on the condition that the broker-dealer was going to repurchase those securities. Sale under repurchase agreement. Now, note the broker-dealer, to get the securities back, has to hand over the initial funds plus some additional funds that represent interest on the transaction, although that's shown as the repurchase price in the second of the two order tickets I referenced previously. And while it doesn't have to be the same securities, it depends on what's been negotiated between the two counterparties. So it's possible for the counterparty, the insurance company in this case, to hand back different but equivalent securities. But in the vast majority of repurchase agreements, whatever securities the broker-dealer pledged, they're going to get those very same securities back in return. Now, if I hadn't described this transaction as a sale and repurchase, if I had simply described a situation where when the broker-dealer hands over some securities, they get money, and when they return the money with interest, they get the securities back, you would have described that as of course, as a collateralized loan. And that is the substance of these transactions. Despite the name, and the formal name, the sale under repurchase agreement, simply contributes to the masking of the real substance. What's really going on here is it's a collateralized loan. Now, why maintain the fiction and the charade that it's a sale and repurchase rather than simply call it a collateralized loan? Well, that's because under U.S. securities laws and banking regulations, it would be illegal for anyone to make a loan to a broker-dealer and get collateral in return except a commercial bank. Who would devise such verbal sleight of hand, misdirecting with words away from the true substance of the transaction? Well, believe it or not, the reality is that it's buried in the mists of the raft of regulations that followed in the train of the stock market crash of '29 and the ensuing depression. As has been true in the more recent financial crisis, The elected legislators and the regulators didn't want to take the blame. They had to point the finger at some bad guy as the responsible party. And just like in the recent turmoil, it was the greedy bankers, of course. So while it is not really the case, the stock market crash of '29 was believed to be the cause of the ensuing depression. And of course, one of the contributing factors was the failure of a great number of banks. And at least purportedly, a lot of those banks failed because of excessive speculation in the stock market. So when the stock market crashed in '29, that's what dragged down the banks, and that's what was one of the major contributors to the depression. Now, of course, the real cause of the depression was the Federal Reserve Board being asleep at the wheel and letting the money supply shrink by a third between 1929 and 1933. And that's why about a third of federally chartered banks failed over that time period. But nonetheless, Congress and the regulators were looking for a whipping boy. They blamed the banks. So GlassSteagall, which many of you would have heard of, was the federal regulation that separated commercial banking from investment banking. Because prior to the 1932 passage of that legislation, most of the large financial institutions engaged in both sort of activities. Commercial banking, taking deposits and making commercial loans. Investment banking, securities trading and underwriting. So Congress, wanting to foist the blame off on the greedy bankers, said, well, if we separate those two activities, that will prevent commercial banks from ever engaging in this speculative stock market activity, and thereby avoiding any bank failures if there's a significant decline in the stock market. Now, despite the fact that wasn't the cause, nonetheless, that was the resolution Congress decided to use. However, as a result of the very slack economic environment, you had the financial system, and in particular the commercial banks, laid low financially. And how are the commercial banks going to be able to earn their way back to financial health? Because guess what? They had made the bulk of their revenue and profits from their investment banking activities. So how are the banks going to earn their way back to financial health if Congress has just taken away from them their best money spinner? Well, as is often the case, when Congress does something they realize will have really negative impacts, they'll try to do a make-good, a fix-it by changing something somewhere else. As a recent example, Congress realized the Affordable Care Act was going to blow a huge hole in the budget, so Congress took over the student loan business as a way of recognizing revenue from student loans to pay for the Affordable Care Act. Well, back in the 1930s, Congress realized that one of the bank's primary source of revenue and profitability were their investment banking activities. To make up for that huge hole in their sources of revenue, Congress hit upon a particular stratagem. Broker-dealers have huge financing needs. I mean, by way of example, think of the large government securities dealers in today's markets. They will have tens of billions of dollars of equity capital, but their overnight bond inventories might be $150, $200, $300 billion in size. How do you hold $200 or $300 billion worth of securities with a piddling $40 or $50 billion worth of equities capital? Well, of course, they do it with a lot of other people's money, and the repo market is one of the primary ways they get other people's money. But to finish that story, who in their right mind would lend money to a broker-dealer without getting collateral in return? The brokerage business is inherently extremely risky. Well, that's why Congress hit upon the stratagem of saying anyone can make a loan to a broker-dealer, but only commercial banks can receive collateral in return. So consequently, that at least initially forced the broker-dealers into the arms of the commercial banks to finance their bond inventories, thus generating sort of an annuity stream of income to the commercial banks, providing the financing to broker-dealers. But somewhere in the 1940s or 50s, somebody in the securities business realized, hey, there's a workaround here. If we don't call it a collateralized loan, but rather call it a sale and repurchase, that will allow us to neatly avoid the restrictions that are put in place by the securities and banking regulations. Like much financial innovation, repos are really a form of regulatory arbitrage. Because again, in substance, it's nothing more than a collateralized loan. So if the U.S. government wanted to, they could quash that market in a minute because it is an in substance violation of federal law. But of course, since this is a financing vehicle heavily used in the Treasury and agency mortgage-backed securities pass-through market, the government is one of the primary beneficiaries of the existence of this type of trade. In fact, half of the states will interpret it as a collateralized loan, but the other half of the states and the federal government treat it as a sale and repurchase agreement. So it is clearly the case that these are important investing tools from the standpoint of money market investors, but to have a fuller appreciation of the substance of the transactions, it's best to realize what is in actuality going on. A sale and repurchase of securities is really nothing more than a collateralized loan. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.